Hi there, it's Friday the 13th of December 2019. I'm Steve Towers. Welcome to ITB. Let's get started. The Pillar 2 public consultation meeting occurred on Monday this week. There were no real surprises. Let me give you the key takeaways. Firstly, there was significant support amongst business representatives for using the ultimate parent company's consolidated financial statements as the starting point for calculations. Secondly, the business representatives also strongly supported the use of worldwide blending in determining the effective tax rate. However, there was pushback on this point from representatives from developing countries and civil society groups. Third, in regard to carve-outs, a number of participants argued that there should be a carve-out for routine profits. In other words, the Globe proposal should apply only to residual profits. Fourth, everyone seemed to agree that the administrative burden on multinationals and tax authorities should be minimised. And finally, the timetable for the next steps was outlined. Another public consultation meeting, possibly in March, and final version of the Globe proposal to be issued in late June or early July. If you'd like to watch a video of Monday's public consultation meeting, please go to our website or app. Well, folks are still trying to understand the ramifications of Secretary Mnuchin's comment last week that the US government wants Pillar 1 to be a safe harbour. But I think one thing is clear. The US government is not walking away from the Inclusive Frameworks Digitalisation project. Let me discuss two issues. The first is, why would a multinational choose to opt in to Pillar 1? I can think of two possible answers. Firstly, for those multinationals which will be subject to unilateral taxes, such as digital services tax, Pillar 1 might provide a lower foreign tax cost and/or a lower administrative cost. And secondly, for all multinationals, Pillar 1 should provide protection against aggressive claims in regard to taxable presence and transfer pricing. And again, it might therefore provide a lower foreign tax cost and/or lower administrative cost. The second issue is, what are the possible outcomes if the inclusive framework does not accept Pillar 1 as a safe harbour? Mindy Hersfeld, writing in Tax Notes Today International, has identified three possible unattractive outcomes. Firstly, the collapse of Pillar 1 and the proliferation of DSTs and other unilateral taxes. Secondly, the maintenance of the status quo, with even more aggressive claims on taxable presence and transfer pricing. And thirdly, Pillar 1 proceeds without the US, which might lead to global isolation of the US in regard to international tax. Now, a quick roundup of the latest developments with DSTs. In the Czech Republic, the bill for the DST has been introduced into Parliament. The government expects that it will be effective in mid-2020. In Turkey, the DST will be effective the 1st of March 2020. And in regard to the US proposed retaliation against the French DST, it's been reported that the US Trade Representative will meet with his EU counterpart in January. It looks like the USMCA, the trade agreement which was signed in November 2018 and which is intended to replace NAFTA, will likely come into effect. This week, the three countries signed a protocol which introduces amendments required by the US Democrats and a significant US workers' union. Ratification in the three countries is now required. In regard to the China-US trade war, it looks likely that an 11th hour deal between the two governments will avoid the imposition of an additional customs duty on imports from China, which is scheduled to be implemented on Sunday. It's been reported that the deal will also roll back some existing US tariff rates in return for increased Chinese purchases of US agricultural products and some other concessions. And it looks likely that the Conservatives have won yesterday's UK election with a large majority. So that means that the bill to approve the Brexit agreement now has a reasonable prospect of being passed by Parliament in time for the UK's scheduled departure from the EU on the 31st of January. In Australia, the government has released for public comment an options paper in regard to its ongoing public consultation on the definition of resident for corporate income tax purposes. The paper describes two possible options. The first is the retention of the existing central management and control test. And the second option is to adopt an incorporation-only test. The paper also notes that the treaty tiebreaker test, place of effective management, has little support. Public comments are requested by the 31st of January. For a copy of the paper, please go to our website or app. Also in Australia, the tax authorities have issued guidance on when a supply of anything other than goods or real property is connected with Australia's indirect tax zone for GST purposes. For a copy of the guidance, please go to our website or app. In China, the government has announced the extension to the 31st of December 2022 of the individual income tax exemption for profits derived from the sale of shares listed on the Hong Kong Stock Exchange. For a copy of the announcement, please go to our website or app. In Hong Kong, the government has published a bill to implement the previously announced expansion of a concessional tax rate for insurance and reinsurance business. The bill is scheduled to be introduced into Parliament next week. For a copy of the bill, please go to our website or app. Also in Hong Kong, the Board of Review has decided a case in regard to the source of profits derived by a Hong Kong company. The Hong Kong company, which was a subsidiary in a multinational group, conducted two types of profit-making activity. The first activity is shown on the left. ACO is a related company which is resident in Country U. The Hong Kong company performed procurement and sourcing services for ACO in regard to unrelated suppliers of goods in mainland China. The sales were made directly from the suppliers to ACO. For its services, ACO paid the Hong Kong company a commission. And the second activity is shown on the right. The Hong Kong company, as principal, purchased goods from unrelated suppliers in mainland China and sold the goods to unrelated customers in Country U. ACO performed significant marketing and distribution services for the Hong Kong company, which paid ACO a fee. The Hong Kong company derived trading profits from this activity. In regard to both activities, the tax issue was this: was the Hong Kong company's income or profit derived from a source in Hong Kong or outside Hong Kong? Importantly, transfer pricing, in other words, the pricing of the intragroup transactions with ACO, was not an issue in the case. In regard to the commission income, the Board of Review held that the substantive profit-making activity was the performance of the procurement and sourcing services, and these were performed by the Hong Kong company's employees in mainland China. The board therefore held that the commission income was derived from a source outside Hong Kong. And in regard to the trading profits, the board held that the substantive profit-making activity was the performance of the marketing and distribution services by ACO in Country U, and therefore the board held that the trading profits were derived from a source outside Hong Kong. And as Hong Kong's profits tax is based on the territorial system, the board therefore concluded that both the commission income and the trading profits were exempt from tax. For a copy of this case, please go to our website or app. In India, the Mumbai Income Tax Appellate Tribunal has decided a transfer pricing case concerning HSBC. There's a number of tax issues in the case, but one issue is particularly interesting, and that concerns reciprocal services between the Indian branch and overseas branches and subsidiaries within the group. The Indian branch of HSBC managed relationships with unrelated Indian non-bank financial institutions, to which it provided various banking services and products. These FIs were attracted to HSBC due to its network of branches outside India. As an incidental part of its business, the Indian branch marketed to the FIs the correspondent banking services, for example, Nostro accounts and trade finance services, which were available through overseas branches and foreign subsidiaries within the group. Those overseas branches and foreign subsidiaries provided similar marketing services in regard to correspondent banking services which were available with the Indian branch. There were no charges made for the reciprocal marketing services, not even a cost recharge. The Indian tax authorities claimed that a charge should be made for the marketing services provided by the Indian branch, and that the charge should be on a cost-plus basis. The tribunal disagreed. It held that no transfer pricing adjustment should be made. The tribunal said this: "It is important to emphasize that the global network of the branch is a direct asset and mainly benefits the branch to have global reach and the ability to offer services under its network. This directly encourages FIs to approach the branch for the services as compared to others who may not have such global reach. It may also be noted that the overseas HSBC branches also provide services that benefit the branch, that is, in selling INR Vostro accounts of the branch to banks domiciled outside India. The branch does not pay any amount to overseas HSBC branches for such marketing services." It is also pertinent to note that as a result of various services of overseas HSBC branches, as above, the branch had earned float income on the interest-free balances maintained by the Indian banks which have maintained Vostro accounts with the branch. Hence, it could be safely concluded that the branch and the overseas HSBC officers, being a part of the HSBC group, derived reciprocal benefits, and thus the non-charging of costs for providing the incidental marketing support services to overseas HSBC entities would not cause any prejudice to the interest of the branch as well as the revenue. For a copy of this case, please go to our website or app. And also in India, it's been reported that the government has proposed the introduction of a GST lottery based on receipts consumers receive for their purchases. As I mentioned in ITB 2 weeks ago, this idea has been implemented in a number of EU member states to increase VAT compliance. In Malaysia, the tax authorities have issued guidance on the determination of the tax residency status of companies and bodies of persons. For a copy of the guidance, please go to our website or app. In New Zealand, the tax authorities have released for public comment an issues paper on the tax aspects of the allocation of price in business sales. Public comments are requested by the 14th of February. For a copy of the paper, please go to our website or app. Also in New Zealand, the tax authorities have released for public comment draft guidance on the proposed changes to the R&D tax incentive. Public comments are requested by the 11th of February. For a copy of the draft guidance, please go to our website or app. In Austria, the government has released an updated version of its VAT guidelines. For a copy of the updated guidelines, please go to our website or app. In the EU, Ecofin has published a report on tax issues. Here is a list of the interesting topics which are discussed in the report. Please hit the pause button to study this list. And the most interesting aspect of the report is the acknowledgement that progress towards a definitive VAT system is not going well. Here's the first part of the report's discussion of this topic. I won't read it out. Please hit the pause button to study it. Here's the second part. Again, please hit the pause button to study it. And here's the final part of the discussion on lack of progress with the definitive VAT system. For a copy of Ecofin's report, please go to our website or app. Also in the EU, there have been several developments this week in regard to carbon emissions. First and foremost, the European Commission has released a document on the European Green Deal. The document includes a number of references to aligning EU taxation rules to support the EU's targets on carbon emissions. For a copy of this document, please go to our website or app. Secondly, Ecofin has agreed to update the EU's energy taxation rules. For a copy of Ecofin's press release, please go to our website or app. And the European Airline Industry Association has claimed that increasing aviation taxes is an incorrect way of reducing carbon emissions. Airlines for Europe issued a press release which says, in part, aviation taxes do nothing for the environment. On the contrary, they limit airlines' ability to invest in new aircraft, innovation, and sustainable fuels. For a copy of this press release, please go to our website or app. In regard to non-cooperative tax jurisdictions, Ecofin has endorsed a report by the EU's Code of Conduct Group on business taxation. the most interesting aspect of the report is that all member states are invited to implement into national legislation one of the 4 so-called defensive measures by the 1st of January 2021. For a copy of this report, please go to our website or app. You will remember that the proposed financial transaction tax has been pursued for many years by a group of 10 EU member states. The latest development is that one of the 10, Germany, has this week put forward a proposed design for the FTT, which involves a 0.2% tax on purchases of shares in listed companies with a market capitalisation of over €1 billion, and a range of exemptions for shares purchased in IPOs, market-making activities, and other situations. For a copy of a press release from the German Ministry of Finance, please go to our website or app. And speaking of Germany, the European Commission has opened an in-depth state aid investigation into Germany's special tax treatment of casino operators. For a copy of the announcement in the Commission's daily news bulletin, please go to our website or app. And finally, in the EU, there's been slow progress amongst the member states in legislating the VAT quick fixes, which has a deadline of the 31st of December 2019. At last count, only 12 member states had done so. And both the Czech Republic and Romania have announced that the legislation will be passed only in 2020. In Finland, the Supreme Administrative Court has decided a case in regard to the country's group contribution regime, which is the method used for tax loss transfers within a corporate group. Here is the relevant structure. A Finnish company, ACO, owns 100% of the shares in another Finnish company, EXCO. Until 2012, EXCO conducted an R&D business. However, in 2012, it ceased all business activity. In 2019, EXCO is incurring expenses which relate to its proposed dissolution. ACO wants to obtain an effective tax deduction for EXCO's dissolution expenses by making a tax-deductible group contribution to EXCO. The court held that, yes, ACO can make a deductible group contribution to EXCO to cover EXCO's dissolution expenses. Key to this decision is the court's view that dissolution expenses are normal business expenses for a company. For a copy of this case, please go to our website or app. In Norway, the tax authorities have issued guidance on the interest limitation rules. For a copy of the guidance, please go to our website or app. In Poland, the government has announced the deferral, yet again, of the introduction of a key part of the country's withholding tax reform. That aspect is the obligation for payers to withhold tax at the domestic rate of 19% or 20%, regardless of relief under a double tax treaty or EU directive. This is the third time this measure has been deferred. According to the government, it will now commence on the 30th of June 2020. In Nigeria, the tax authorities have issued guidance on the claiming of double tax treaty benefits. For a copy of the guidance, please go to our website or app. In Saudi Arabia, the tax authorities have published 2 items of VAT guidance. The first is on the supply of services to non-GCC residents, and the second is on real estate investment and real estate financing. For a copy of both items of guidance, please go to our website or app. In Costa Rica, the government has launched a public consultation on a proposal to impose VAT collection obligations in regard to inbound digital services on issuers of credit and debit cards, a collection mechanism which is widely used in Latin America. In Mexico, the act which legislates the 2020 budget has now been published in the official Gazette. For a copy of the act, please go to our website or app. The act will make some significant changes to Mexico's tax laws, with many of the changes effective on the 1st of January 2020. Let me take you through the highlights, starting with corporate income tax. Firstly, foreign transparent entities will generally be treated as taxable entities for Mexican income tax purposes, effective the 1st of January 2021. There are exceptions for foreign legal vehicles which are managed by private equity funds, foreign pension funds, and sovereign wealth funds. Secondly, an earnings stripping rule with the interest limit set at 30% of EBITDA will apply. Non-deductible interest expense can be carried forward for 10 years. The earnings stripping rule will apply to all interest, whether paid to related or unrelated parties, and whether to resident or non-resident parties. Financial institutions will be exempt from this rule. Also, many infrastructure, real estate, and resource projects will also be exempt. Third, a GAR will be introduced. This rule will allow the tax authorities to recharacterize a transaction which lacks a business purpose, which includes a situation where the reasonably expected non-tax economic benefit is less than the tax benefit. The burden of proof in regard to business purpose is placed on the taxpayer. Fourth, there will be mandatory reporting requirements for certain tax planning arrangements, such as hybrid arrangements, transactions where accounting and tax values differ by more than 20%, and transfers of tax losses. These rules will be effective from the 1st of January 2021 in regard to reportable transactions where the tax benefit is obtained on or after the 1st of January 2020. Fifth, there will be an expansion of the existing rule which denies deductions for payments made to related parties resident in low-tax jurisdictions. For this purpose, a jurisdiction is considered to be low tax if an entity's effective tax rate, including state and local taxes, is less than 22.5%. The expansion is the removal of an exception for payments to the extent they satisfy the arm's length principle. However, the expanded rule will have an exception which relates to the substance of the related party. Is it engaged in a business activity, and does it have the necessary personnel and assets? Now, let me briefly deal with the changes involving digital platforms and digital services, which will generally apply to non-residents from the 1st of June 2020. Firstly, operators of digital platforms will be required to withhold both income tax and VAT on payments to Mexican resident individuals who sell goods or services through their platforms. This obligation will apply regardless of whether the operator is resident or not in Mexico, and if non-resident, regardless of whether the operator has a PE in Mexico. Secondly, foreign suppliers of specified digital services, whether B2B or B2C, will be required to register for, charge, and remit Mexican VAT on transactions which have a deemed Mexican source. A deemed Mexican source can arise in a number of situations. The specified digital services are all directed towards consumers. In the US, the IRS has announced the deferral of the applicability date for foreign currency regulations under Section 987. For a copy of the IRS's announcement in Notice 2019-65, please go to our website or app. And now for this week's treaty developments. We've had 2 treaties signed, 2 protocols signed, and 1 protocol enter into force. I have 2 articles for you this week. The first article is called The Principal Purpose Test, a critical analysis of its substantive and procedural aspects, parts 1 and 2. It's written by Ian Zara and it's published in the Bulletin for International Taxation. Part 1 of the article focuses on the substantive aspects of the PPT. As you would expect, the author closely examines each of the 2 limbs in the PPT, as well as the examples which are contained in the BEPS Action 6 final report and the OECD commentary on Article 29.9. And then in Part 2 of the article, the author focuses on the procedural aspects of the PPT. Issues such as, is the PPT a matter of self-assessment or is its application a power of the tax authorities? Who has the burden of proof? And what is the effect of applying the PPT? The author is particularly critical of the examples in the Action 6 final report and the OECD commentary. When analysing the PPT's substantive matters, the author has demonstrated that the OECD's guidance is equally abundant and incoherent. In the Action 6 report and the commentary, the OECD attempted to provide a consolidated approach to interpret the PPT. At face value, the general guidance gives a somewhat clear indication on what tax authorities and taxpayers should understand by the phrases one of the principal purposes, the object and purpose of the relevant provisions, and arrangement or transaction. According to the OECD, where there is a presence of one of the principal purposes and the purpose-based test is satisfied, the last part of the PPT permits the person to whom the benefit would otherwise be denied the possibility to demonstrate accordance with the object and purpose of the relevant provisions of the tax treaty in question through the second test. The kernel of the problem lies in the relationship between this guidance and the examples provided for in the OECD commentary on Article 29. These examples do not always follow the previously noted logical reasoning. On the contrary, some examples mix the purpose-based and disapplication tests into one main test. This inconsistency is revealed in examples D, which concerns a collective investment vehicle with a majority of investors in the residence jurisdiction, and K, which concerns a regional investment platform. In the author's view, such a discrepancy may result in added confusion and puts at risk the general consistency of the PPT in its substantive application across the board. The second article is called Rethinking Interquartile Ranges. It's written by Finn Martinson and it's published in the International Transfer Pricing Journal. The synopsis says this: the interquartile range has become the international de facto standard for transfer pricing benchmarking studies. However, it is not a statistically robust method to trim a range of values. Instead of quartiles, confidence intervals of quartiles should be applied. This approach is in line with OECD TP guidance and furthermore provides a clear criterion for an often neglected aspect of OECD TP guidance, that benchmark ranges should only be narrowed in the case of a sizable number of observations. The author suggests that the full range should always be used for sets of less than 27 comparables. The suggested methodology can be easily implemented using standard spreadsheet software. If you're a transfer pricing specialist, you should read this article. Well, that's the way it is this Friday, the 13th of December, 2019. I'm Steve Towers. Have a great weekend.